Mike Tedeschi, Portfolio Manager over at Perspective Wealth Planning. We have a ton to cover in today's video. Markets continuing to trend lower after the inflation numbers that came out yesterday. I'm filming this video before the bell on Thursday, and all the major indexes are red. We've got the S&P 500 up on the chart right now, down almost 1% this morning. The NASDAQ down almost 1.5% already this morning. Let's take a look at some key levels on these charts that we're really watching. Now, when it comes to the S&P 500, that's what we've got up here on the screen. We talked about the importance of this 4,300, 4,100 zone. We traded in it for 2 weeks. The bears won that battle and broke us to the downside, taking us to a lower low for the year. So the S&P 500 trading at the lowest levels of the year. And on this chart, the really important zone was this breakout that we had back in 2020 on the S&P 500, right? We had the big thrust lower in the beginning of the year off of the initial panic. We made a little bit of a pullback. We pushed up. We made this nice ascending triangle pattern and broke to the upside. This zone from this 2020 breakout is the major level that we're watching for a potential test here in the near term. As we have continued to make this breakdown lower on the S&P 500, back testing the breakout from 2020 is the logical spot from a psychological standpoint, right? Fed put a ton of money into the market in here, helped push things higher. Fed starting to take money out with the rate hikes and selling of bonds, etc., and starting to push things lower. It would not be that far of a stretch to go back and test those key levels from 2020 that were breakouts and see if they act now as support, right? This was resistance. Will act as support when we come back down here. That's the main level that we're watching on the bigger picture in on the S&P 500. On the NASDAQ, you can see we broke below on the NASDAQ chart that same breakout spot that I had on the S&P 500 from the second half of 2020 was right in here at this 13,000-ish to 12,000-ish zone. However, the NASDAQ made breaks to new highs much earlier than the rest of the indexes. Tech was the area that really performed well off of the coronavirus bottom and was a leadership name. So that breakout spot was back in June instead of where the S&P broke out later in the year. That zone is right around a major psychological level as well. It's 10,000. It's that big round number. And that's the level that if we continue to head lower, we're really got to pay very close attention to. Same kind of comments apply, right? Fed put money in here. We pushed higher for a while. Fed starts to take money out. What makes sense to kind of backtest? That important key zone. If we continue to head lower, that 10,000 level does seem like that is where we are ultimately going to be testing. Now, let's take a look in at the Dow. The Dow's key level from the breakout happened in November, right around the same time the S&P 500, and it's just above 29,000. This has held up much better this year. Value has done much better than growth. We've talked about it a ton of times. However, this, just like the rest of the market, has started to head lower. It's sitting at the lows of the year. We're back at 31,500. That's where we were in February of 2021, so we have now undone a year's worth of gains at this point in time. This is the major level that we're going to be paying attention to moving forward. Just underneath of that 30,000 level, right around that 29,000 level, that break from November. So if we continue to see weakness, that would be the logical area where we could start to see a major battle happen once again between whether that is going to be support or whether it is going to ultimately become resistance again. Now, the Russell's been the weakest. We've talked about this for a long time. This year, it has continued to head lower, and it actually started to top out much earlier than the rest of the market. The S&P 500, the NASDAQ, the Dow all put their highs in somewhere around the beginning of the year. The Russell put its highs back in October of last year and has been moving lower since that point in time. It is now testing the 2020 breakout zone. So this is the first index that is back down at that 2020 breakout level. This is testing the entire move higher at this point in time. It's that 1700 level in on the Russell. And what happens here is super important, because if this breaks, we've talked about it a ton, we look at the mid and small cap area of the market as a gauge of risk on, risk off behavior, right? People are willing to invest in the riskier assets for potential higher returns when things look good. When things in the economy don't look good, people are not taking those chances on those higher risk areas of the market. They're going into safer areas of the market, and that is what we have seen this year, right? If we look at, let's say, utility stocks are basically right at that flat point for the year. I think they're down like 0.1% for the year. They've been green a couple of times, but this is a major outperformance over the rest of the market. You've got consumer staples, which have held up very, very well, another defensive area of the market. We're looking at names like General Mills coming up and making new highs, Kellogg's, Kraft. Those are making new 52-week highs, over the last couple of sessions. Those are safety areas of the market. You also come in here and we take a look at healthcare. Healthcare has held up better than the overall market. It was leadership until the beginning, really the middle of April, and then it has turned down along with everything else, but it has held up better than a lot of the other areas of the market. And then we have like some literal defense names like Lockheed Martin that have held up really well. It's nice and green for the year still. Raytheon's about flat for the year. Some things like that. Those are areas of the market. General Dynamics up near those highs as well. Right? Definitely clear outperformance of the overall market. Those are the areas that are leading us to the upside. The areas that are leading us to the downside is the Russell. It's the NASDAQ. It's the growth area of the market. It's the higher speculative area of the market. And that is not something that you see during healthy bull markets. All right. We're going to talk about another speculative area. Let's jump in and let's take a look in at Bitcoin. Now, Bitcoin, the low from last year was right around that 28,000 level. That was the breakout right at December of 2020, right in the January of 2021 was right there. And then we had that test, January, and we had one more test of that zone in June. So this has been a major, major level here now for the last year or two. And up until this last week, we still had higher lows being put in the crypto space. Well, that has subsequently broken down. We failed to get back up over 40,000 after the Fed, and it has been a straight move lower, and we're now back underneath of that 28,000 level. This does not look good for the entire crypto space. We come in here and we take a look at this. Where's that next level of major support? It's that big psychological 20,000 level, and it had its major breakout in October of 2020 at the 12,000 level. Those are going to be the two levels that we need to watch in on the downside. All right. For this market to kind of repair itself, it needs to be back up over this 34,000 level. And that's what we're watching in on the upside. Now, the U.S. dollar continues its major move higher here. And I want to back this out. We're going to look at this in on a monthly chart going all the way back to 2000s right here. Right here's 2000. The U.S. dollar is now trading at the highest level it has traded since 2002. So we're at 20-year essentially highs in on the U.S. dollar. And we had a multi-year, almost a decade at this point, not quite, like 9 years, of sideways action on the U.S. dollar between 88.90 and on the upside that 102 zone. We are now breaking above it if we close this month over here. So again, it would be the highest monthly close. It'd be a clean breakout. Our next real level of resistance comes up to this 110. But we know, that they say the bigger the base, the bigger the space, meaning the longer you have something consolidating inside of a zone, sometimes you get those really, really explosive moves when you come out of it. This could just be the start of the dollar's move. If the Fed continues its hiking cycle, it has been the only area of the market that really has been the flight to safety. Typically, historically, we see things like bonds holding up well. Bonds have obviously not done very well this year either, because in a hiking rate environment, bonds work inverse. Now, what is very interesting, again, I have a monthly chart of the 30-year Treasury bonds up. The key level in on this chart was that 135 zone. It's the lows from 2018, 2019, the taper tantrum that we had back then, right? We pulled directly into that zone and actually have bounced here over the last few sessions pretty strongly. All right, this has been an area that has been, obliterated this year, and we got a 4.5% move off of the bottom, which is a big move for 30-year bonds at this key level. This does not mean the bottom has been put in. It just does look like a potential area for support and a little bit of a, maybe a move back to your mean, which would be back up here. This would be perfectly normal price action. We have major resistance up here at this 152 level. That was a big breakdown, and you can see a kind of head and shoulders top pattern that's in there. This did undercut this, and that's the first time we have made a lower low in bonds going as far back as this chart goes, which is 1997. Here's a low, here's a higher low, 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 technically a lower low, right? It's about equal, so maybe we can call this a flat zone here, right? But underneath the 135, your next area of support comes in at 126, and then you don't have much until you get all the way back down here. So this zone is very, very important for bond bulls to hold. We're watching this very closely if we head back down, because again, this is only a 3 or 4 day bounce. I know this is monthly candles, but if we get underneath of that 135 zone, that would be very bad for this space. I'll zoom in a little bit more detail on daily charts. You can clearly see the battleground zone, the importance of this, really from 2013, 2014. This was your resistance, and then it acted as support. Once we got above it, we got that tested in 18. Once again, there, it acted as support, and you've tested it again right here. So very, very important level in on bonds. Jump in, take a couple look at some other commodities, and then we're going to wrap this video up for today. Come in here and we're going to take a look at oil. Oil still can't get below that 95 zone, right? We've had some, some selling. We were up at 110. A couple of days later, we were underneath of 100. We're back up. Basically, we've traded in the middle of this zone now since February, right? We're making this kind of pattern, right? Nobody's winning this battle at this point in time. We did come from below. You have a higher propensity for markets to continue the direction in which they came into the pattern, but it's got to prove it to us. Underneath 94, that would kind of change the look of this chart. We're paying very close attention to it. Oil is a big concern for a lot of people at this point in time, specifically when we look at it from the lens of gasoline, which is trading up at those highs. I'm going to back this out on a monthly chart. Most expensive gasoline futures that we've seen in the last decade, pushing right up here almost into that $4 zone. This is just money out of consumers' pockets, right? You've got to travel from point A to point B. The cost to do that, if it continues to go up, you still have to pay it. That's additional money that you don't have to spend on other areas of the economy. So the stronger that this oil and gas stays, the more money that's coming out of the American consumer's pocket, the less they can spend on those discretionary items, and overall not necessarily a great sign for the economy as a whole. The last area I want to take a look at is in the precious metals market. Gold just can't get going. It had that potential to take that 2100 out, has not, right? A lot of people are looking at this as this beautiful cup potential handle. This is starting to fall too deep to really be able to call this a handle at this point in time. This looks more like a potential multi-year double top, but it hasn't taken out the major support levels below that 1800 and really this 1700, right? This zone here, if you fall below that, that would very much confirm that this was a double top. All right, we're still kind of in the middle of that zone. If you look at gold, gold is pretty much trading at the same spot since July of 2020 now. Okay, here's July of 2020. Here's where we are today. Okay, so we're paying very close attention to this level. The more speculative of precious metals at this point in time, silver actually breaking down finally underneath of that 22 zone. We're now actually underneath 21, back in the 20s. Its key level is 19.5. That's the area that we need to continue to watch there. And we come in and we take a look at platinum, still holding up around that 1,000 mark. And last but not least, we'll take a look in at palladium. Palladium back underneath of that 2,000 level. So the strong dollar is finally kind of pushing those precious metals lower here. That's not what the gold bulls want to see in an inflationary environment. Gold not going up and the dollar going up. It makes things very tough in that area of the market. As always, guys, I hope this information was useful. If you got any questions, feel free to reach out to me. You can reach me at mtedeschi@perspectivewealthplanning.com, or you can reach me at 814-580-9881. I hope you guys have yourself a fantastic day. I'll see you all tomorrow. Take care.